Hi there. If you are a value investor, don't watch this video. But if you are interested in this stock, Senseonics, or you plan to invest in this business, then you have to keep watching because there is a lot of risk with this company. As you can see, the stock price has declined by over 80% from its peak. Now, the market cap is around 400 million and they say that the PE ratio is around 14 and the price has increased by 40%. Now, if you look behind these earnings, you'll find something else. So in this image, you can see the analyst estimates. The revenue is expected to increase from 16 million to 52 million by 2025, but their profits are expected to decline from 142 million to a decline of 86 million. Be aware that the market cap is around 400 million. So as they made over 100 million in 2022, this business was a great investment at that time based on their earnings. But if you look at their earnings, yes, they report a profit of over 100 million for 2022. But if you look deeper, you can see that their operating earnings were with minus 68 million. So they made 60 million revenue, but they spent 68 million to make that revenue. So this is a great business. Same for 2021 and 2020. And their net income came from a change in fair value of derivatives, not from their operating earnings. And that's why they reported a profit in 2022. So when you see this PE ratio around 14, this doesn't represent the real earnings. So be quite careful. Now, they have 146 million in cash. So compared to the market cap around 440 million, that's good. Plus 51 million in debt. And they expect for the full year 2023 the global net revenue to be around 20 million, as the analyst expects around 22 million. Now if you wonder what this company is doing, they develop a sensor. They call it SENS, which measures the glucose level in people with diabetes. So this sensor is an implant that the doctor inserts in your arm, and it can measure your glucose level, and you can use their app to see your results. Now, once you got the main idea of their product, they generate revenue from selling that SENS system to Ascensia and other distributors. Now, if you read more about this company, you'll find out that 92% of their total revenue came from one customer, which is Ascensia. So Senseonics is depending a lot on only one customer, which is Ascensia. And the revenue came from the United States and outside the US. So this is the second problem. Then for the first quarter of 2023, they had the same story. Net income 1.3 million, but their operating earnings were with minus 19 million. And their profits came from an exchange gain. So these earnings are not the real earnings. That's why you have to focus on their operating earnings or operating loss, which is minus 19 million. Moreover, there is another problem you should be aware, and that is dilution. When you see something like this, it's better to avoid the stock. As you can see, the number of shares has increased from 200 million to almost 500 million. So they more than doubled the number of shares. And that's why you see this decline in the stock price of over 80%. As they are making no money, their operating earnings, they are likely to issue more shares in the future. This means the value of this company will decrease even more in the future. So that's why you have to be aware of this company, especially their earnings. This nice PE ratio around 14 may say that this is a good investment, but if you look deeper at their earnings, you'll find out that the earnings are not that great. So if you want to value this business, you can't, because they have no real earnings and the analyst expects more losses in the future. Now you can try to value this business based on the revenue, but even so, the stock price is quite overvalued at the current level. Just look at their future revenue. So the analyst expects 52 million in revenue by 2025. And if you compare that to the current market cap, 52 million to over 400 million, the stock price is quite expensive. You might say that they have great opportunities, that they can sell this product all over the world. But if they start to make some profits, they will attract more competition. And this product is quite easy to be copied. It's not that hard to create an implant that can measure your glucose level. It's quite easy. So if you want to invest in this company for the long term, it's better to avoid this stock. Now, if you are a trader and you want to speculate, be my guest. You might make some money in the short term, but as I said, there is a lot of risk with this company. Fake earnings, dilution, and their business model is not sustainable. Also, the analysts expect more losses in the future. So you have to be aware of this business. Don't get me wrong, I want to help you to avoid the risk of losing your money. And if you have any questions, or if you want me to analyze something new, please let me know in the comments.